Current market action for Navitas Semiconductor, ticker symbol NVTS, shows the stock trading right around $8.61, pushing upward with an intraday gain of approximately 0.88%. The market is currently live, and we are seeing some interesting volatility in the session, with the stock bouncing between a low of roughly $8.52 and a high near $8.68. This follows a previous close of $8.69, and while the movement might seem subtle on the surface, the volume tells a deeper story of consolidation and potential accumulation. We are looking at over 500,000 shares traded already in the early hours, signaling that despite the recent choppy waters, eyes are very much fixed on this semiconductor player. The market cap currently sits just under the $2 billion mark, hovering around $1.97 billion. Here is where the tension lies, and this is the critical hook for everyone watching right now. The expectation for Navitas Semiconductor among the broader, perhaps less informed, retail crowd is that this is primarily a play on mobile charging, the company that makes your phone charger smaller and faster. That is the expectation. The reality, however, is far more aggressive and arguably misunderstood. What we are actually witnessing is a calculated, painful, but potentially massive pivot away from low-margin consumer electronics toward the high-stakes, high-power world of AI data centers and electric vehicles. The market sees a revenue dip and panics. The smart money sees a company clearing the decks to power the next generation of NVIDIA stock-based server racks. If you are looking at this stock solely based on yesterday's mobile phone sales, you are missing the forest for the trees. This disconnect between the mobile charger narrative and the AI power backbone reality is where the opportunity and the risk resides. To understand why the stock is behaving the way it is today, we have to look at the recent price action through the lens of this strategic shift. The stock has seen a significant amount of volatility recently, largely due to their latest earnings report, which acted as a reset button. Management essentially guided Q4 revenue down to a floor of roughly $7 million. Now, in a vacuum, hearing that revenue is dropping would send investors running for the hills, and indeed, we saw that initial knee-jerk reaction. However, the stock has shown remarkable resilience around this $8 level. Why? Because the market is beginning to digest the Navitas 2.0 strategy. This isn't a company losing market share. It is a company deliberately walking away from commoditized, low-margin business in China to focus its resources on high-margin, high-barrier-to-entry markets in the US and Europe. When you see the stock holding steady or inching up as it is today, despite a lowered revenue guide, it suggests that the shareholder base is rotating. The short-term momentum traders are leaving, replaced by longer-term institutional holders who understand the multi-year cycle of semiconductor design wins. Let's take a moment to discuss what exactly Navitas does, because if you are using platforms like Schwab Intelligent Portfolios or considering self-investing, you need to understand the technology, not just the ticker. Navitas is the industry leader in Gallium Nitride, or GaN, and they are also a major player in silicon carbide, or SiC. For decades, legacy silicon chips have been the standard for power conversion. Silicon is cheap, abundant, and well understood. But silicon has hit a physical limit. It can't handle the speed and heat required by modern fast charging, and more importantly, it is becoming a bottleneck for AI data centers that consume megawatts of power. GaN is a wide bandgap semiconductor. Without getting too bogged down in physics, this means it can conduct electrons more than 1,000 times more efficiently than silicon. It can switch up to 20 times faster. What does that mean for a product? It means you can shrink the size of a power supply by half or even more, while wasting far less energy as heat. This is not just an incremental improvement, it is a fundamental shift in the material science of power electronics. Now, consider the broader investment landscape. If you are browsing investing sites or looking for investment help, you will constantly hear about the AI boom. Everyone talks about the brains of AI, the GPUs from NVIDIA stock, or the custom silicon from Apple stock. But very few people talk about the heart and lungs of AI, which is power delivery. An AI server rack consumes an exorbitant amount of electricity. If that power is delivered inefficiently, it generates massive amounts of heat, which then requires massive cooling systems, which consume even more power. It's a vicious cycle. Navitas's GaN technology breaks this cycle by making the power delivery stages roughly 98% efficient. This is why the reality of this stock is so much more interesting than the mobile charger expectation. They are positioning themselves to be the efficiency engine that allows the AI infrastructure build-out to continue without collapsing under its own energy costs. This brings us to the recent news that is likely supporting the price today. Navitas recently announced a major strategic partnership with GlobalFoundries. This is critical for two reasons. First, it secures a U.S.-based manufacturing footprint. In a geopolitical environment where trade tensions with China are a constant risk, having a secure domestic supply chain is a premium asset. Second, GlobalFoundries is a heavyweight in the foundry business. Partnering with them validates Navitas's technology and provides the capacity needed to scale up production for data center clients. This directly counters the fear that Navitas is too exposed to Asian supply chains. It's a maturing of the business model, moving from a fabless design house scraping for capacity to a strategic partner with major foundries. If you are managing an individual brokerage account or looking at fidelity investments, you look for companies that de-risk their supply chain. This partnership does exactly that. Furthermore, we need to address the Navitas 2.0 strategy again because it explains the current financial picture. The company has roughly $150 million in cash and no debt. This is a fortress balance sheet for a company of its size. It gives them the runway to withstand the current revenue dip as they transition. The burn rate is being managed aggressively, with operating expenses being trimmed to around $15 million. They are not burning cash recklessly, they are reallocating it. They are cutting spend on low-end mobile R&D and pouring it into high-power applications for data centers and EVs. This is what you want to see when you invest online or evaluate stocks for a long-term hold. You want management that is willing to take short-term pain for long-term gain. The easy path would have been to keep chasing low-margin mobile volume to keep the revenue chart looking pretty. The hard path, the one they chose, is to sacrifice that revenue now to build a more defensible, higher-margin business for 2026 and beyond. Let's talk about the competition and the sector context. When you look at other players, you might look at Wolfspeed or onsemi. The difference is that Navitas is the only pure-play next-generation power semi company. They don't have a legacy silicon business to protect. This allows them to be more agile and aggressive. However, it also adds risk. They don't have a cash cow legacy business to fund the transition. They have to execute. The market knows this, which is why the stock is volatile. But this volatility is where the opportunity lies for the astute investor using tools like Fidelity Trading Platform or Interactive Brokers Trading. If you believe the management team can execute on the data center pipeline, which they state has grown significantly, then the current valuation, roughly $2 billion, could look very cheap in retrospect. The data center power market alone is expected to double or triple in the coming years. Navitas only needs to capture a small slice of that to see exponential growth from these levels. We also need to consider the electric vehicle market. While the headlines for Tesla stock have been dominated by delivery numbers and robo-taxis, the underlying engineering challenge for all EVs is range and charging speed. Navitas's CIC technology addresses this directly. CIC is better suited for the high-voltage, high-power environment of an EV powertrain than GaN is, currently, although GaN is catching up. By using SiC in the onboard charger and the traction inverter, an EV maker can extend the range of the car or reduce the battery size, saving cost, without changing anything else. This AWB has SiC is the US SiC is and ATSSS, and kind of SiC is an SSSS is